Hi everyone, Kale here with 10 quick slides about this recent stock market volatility. I've heard from a couple of you about it, and I thought I would step back a minute and put some historical context to this recent pullback in the market for Tarpon and to a lesser extent Gecko folio investors too. While this video is focused on general US stock market volatility and not oil market volatility per se, the two are not mutually exclusive. So I think this should also indirectly address any questions you may have about Tarpon's seesawing over the past month too. First, though, the mandatory hello from our compliance lawyer, and then a recent snapshot of Reston, Marie, and I there in the bottom. Okay, here we go. Sort of master of the obvious here, stock market volatility has spiked recently. This is a chart of the VIX, which is a commonly referenced index when it comes to measuring market volatility in general. And the spike you can see there in the far right is what we just went through. You can also compare that to a normal level of volatility as per that dotted red horizontal line that's running across the middle of this chart. And you can also see other spikes of volatility that we've seen since 2010, including going back to the days of the Greece debacle, and then the U.S. debt downgrade in August of 2011, which was particularly unpleasant. A couple of observations here, though. Prior to a few weeks ago, we have had, as you can tell on the sort of right-hand side of this chart, we've had a particularly long period, about 18 months or so, of really extreme calm in the stock market. You can also see here that while volatility often stays low for long periods, those episodes are almost always interrupted by shocks of some kind, and those shocks are typically macroeconomic in nature. Finally, you can also tell by looking at this thing, volatility it's really just a normal part of investing. Investors should, in 99 out of 100 cases, stay disciplined and really just look past short-term market volatility like this, and keep sort of your eyes focused on the long term. Now, just to get ahead of I guess the one question that comment might bring up, what is not on this graph is really the mother of all volatility spikes, which was the bursting of the housing bubble in 08 and 09. So while it is true that ignoring the market turbulence starting in September of 2008 and following that same philosophy I just mentioned of looking past short-term market turbulence, it's true that would have been naive to do in later 2008 and early 2009. This is not 2008. I mean, I get it if you still have PTSD from back then. It's certainly understandable. But what I'm saying is it's okay to ignore this most recent spike in volatility for a bunch of fundamental economic reasons that I'm happy to get into offline if anyone asks. Okay, if we focus on stocks specifically instead of a volatility index like the VIX, and we sort of widen our scope to go as far back as 1980, here is what that chart would look like. This chart shows the performance of the stock market in bars there for each of those years, as well as the largest intra-year decline, which are those reddish-orangish dots for each year. Among other things, you'll note that the average year experiences a stock market drop at some point during the year of about 13.5%. In spite of that, though, most years still end up in positive territory, averaging 9% gains, at least over this period of time. So, just to reiterate that earlier point one more time, withstanding these short-term moves, it absolutely does require some discipline. And we do it not to try and prove how stoic we are or anything. It's just because ignoring them will improve your investment returns in the long term. And so these corrections always seem like the end of the world, at least the time they happen, and really, especially if you watch a lot of CNBC. But the reality is the past few weeks were the sell-offs. 22nd market decline of greater than 5% since the housing bubble-induced lows of March 2009. So while the catalyst or the cause of a sell-off is different each time, and this most recent time it was caused by a very strong jobs report on February 2nd that caused a brief, unexpected spike in bond yields. Again, the reality is this sort of thing is really not so rare after all. This is a snapshot of U.S. market valuations today. This is a 5-year view, and we are over on the right side of this chart, right by the purple arrow, which is really there to just point out that market valuations in general, and by valuations I mean the valuation multiple you are paying to buy U.S. stocks in general, that multiple was until 2 weeks ago as high as it has been in the last 5 years. So valuations in the U.S. stock market, exclusive of oil companies, which is a whole different slideshow, they have been elevated, and when we saw that pop in bond yields a few weeks ago, the rout was on soon thereafter. Same valuation type of slide here, only with a 3-month view to zoom in a little bit on more recent days. You can almost see that recent sell-off stop and start to coalesce or start to stabilize right around that market fair value line, the thicker black bold horizontal line going right through the middle. I would point out here, though, that while this chart is it's explanatory, it's not necessarily predictive, and by that I mean I'm not trying to say or imply here that the market is just going to shoot right back up from where it currently sits and start seeing some more overvalued equities here again. My point is really just that the sell-off seems to have stopped more recently, and that there is sort of real fundamental support, if you will, not in the technical analysis sense, but in the fundamental valuation look at the world. There's support for a market valuation that's really right around here. One of the open questions, I will say, that I still have in my own mind about this recent correction is essentially how much of it should be considered to be this sort of inevitable adjustment in asset values at a time when the world economy has begun to sort of renormalize finally. Or in other words, the question is, are interest rates starting to finally and sustainably rise? You can see here that interest rates have come up relatively quickly the last few months, likely due to recent tax reform in the U.S., as well as the first draft of the 2018 budget the White House put out this week, and certainly some other reasons too. The point being that all that being said, rates are still right now about where they were just 4 years ago, and more recently, the bond market has finally started to calm down a little after that spike in early February. So while there is a little uncertainty about the direction of short-term interest rates, and all that might mean for the economy and stock market, in my mind, that uncertainty is okay for now because number one, there's no real imminent risk behind it. And number two, it should sort of resolve itself anyways. Things should get more certain as more economic data comes in over time here in the U.S. It's also worth pointing out here that for those of you invested in Tarpon and as well as Gecko, there is a pretty viable scenario here where all of this volatility is in sort of an odd way potentially bullish for our companies. And by that I mean to the extent that this recent market decline has reminded investors of the potential perils of owning overvalued or very highly valued stocks like Facebook, which had a great year last year, but which is trading at something I believe north of 40 times earnings or wherever it may be. And frankly, you've got companies, a lot of tech companies like that, which are sort of built on these intangible assets that offer no real protection from inflation or rising rates. Well, then again, there is a pathway where people start or may finally start to notice how crazy cheap and inflation protected things like U.S. oil and gas, U.S. E&P companies are trading at. Again, in the last 30 years, there's never been a gap as large as there has been right now between oil prices and the value of U.S. oil companies. And my point is, maybe all of this volatility starts to get people to maybe rethink the importance of valuation, and puts a little bit more of a spotlight on oil companies in particular. Potentially, we'll see. And also to the extent that inflation does finally start to pick up here too, and it's really not done much to speak of at all lately. But if it does, then all things being equal, that would be another positive tailwind for commodity companies, including companies that we own in those Tarpon and Gecko portfolios. But that's a whole other slideshow. So, okay, let me stay on topic here. To summarize, and at the slight risk of treating all of this a little bit too simplistically, history would suggest that the past few weeks of stock market volatility have been overdue. This little correction will be healthy for the market in the medium term, and though we haven't seen one lately, declines like we just went through are really not at all that uncommon. It may feel unusual, but that's just because things in the broader stock market have been unusually calm the last 18 months prior to February. And finally, I guess I'll also add for Tarpon investors here, to the extent that all the volatility in the oil market we've seen over the last 2 years has increased your tolerance for these sorts of corrections in the broader stock market, and if none of the stock market headlines of the past few weeks really bothered you, then I'm right there with you. I think there's a good chance that we may have sort of unintentionally been immunized through our experiences in the oil market to this broader market panic of late. If other investors think the last few weeks in the broader stock market have been crazy volatile, then boy, we got some stories for them. Anyway, okay, that's it. Please let me know if you have any questions about any of this. You've obviously got contact info. Reach out anytime. Thank you for watching, and have a good President's Day weekend.